Welcome to another S&P 500 analysis. The S&P 500 finally collapsed due to lack of strength the internals have been displaying for the last few weeks. And this collapse came with force and volatility. The S&P 500 did reverse from its low after the first 2 hours of trading on Friday. Does this mean it's out of the wood, or is there more downside to come? In this video, we will analyze the price action of the S&P 500 and review the market internals and the sentiment to see where the S&P 500 might be headed in the coming week and in the near term. And we will also look at the other major market indexes to see what they are saying about the big picture. From this S&P 500 monthly chart, we see September started out on a positive note. It made a new all-time high of 3,588.11. And it appears that it is going to break out from this long-term megaphone channel started from March 2009 bottom. Zooming in on the S&P 500 weekly chart, this week it broke the one-time framing up price trend and printed a bearish outside candle or a bearish engulfing candle. The candle took out the gain from the previous 2 weeks. The range for the week was a little bit more than 238 points or 6.65%. It closed at 3,426.96 for a loss of 81 points or 2.3% for the week. And it is still 33 points above the February high or 0.99% above that high. And for the year, the S&P 500 is still up a little bit over 200 points or slightly above 6%. The 10-week moving average and the 40-week moving average are still up, and the price is still above these two moving averages. So on the weekly basis, the trend is still up. Before we analyze the S&P 500 price action further, let's first take a look at the sentiment and the internal to see what they are telling us about the health of the market. On this sentiment chart, the VIX finally moved above the 20-30 zone and closed the week above 30 at 30.75. At one point on Friday, the VIX went as high as 38.28. The put-call ratio also moved above the 0.75 and closed the week at 0.78. From the VIX and the put-call ratio, definitely the market participants are getting more fearful and are taking off risks and buying protections. The NYSE up-down volume did move negative as the S&P 500 sold off, but the ratio was only modestly negative relative to the amount of sell-off the S&P 500 incurred. With more than 3% loss on Thursday, the up-down volume ratio was only minus 2.7, and on Friday it was minus 1.09. These are not the ratio one would expect for a 3% sell-off. But the daily NYSE advanced decline did show signs of wide participation by majority of the stock during this sell-off. There were 1,793 more declining issues than advancing issue on Thursday, and a modest 749 more decliner than advancer on Friday. From the up-down volume ratio and the daily advanced decline, we have not seen the capitulation from the sell-off yet. So until we do, we should remain cautious. The NYSE new high, new low came down to 27 on Thursday's sell-off and finished the week with 7 more new highs than new lows. NYSE new high, new low continued to show weakness. The S&P 500 finally back in sync with the NYSE cumulative AD line. We have been warned about the negative diversion for the past couple of weeks that the market is getting weak and should be prepared for a correction. Now we are seeing that correction. Turning to the NASDAQ market, the NASDAQ up-down volume ratio is a little bit more negative than the NYSE. It had a minus 3.2 on Thursday and minus 1.3 on Friday. The daily advanced decline is also more negative. It had 2,123 more decliners than advancer on Thursday and 817 more declining issue than advancing issue on Friday. The more negative internal from the NASDAQ should not be a surprise to us, since the recent market rally was mainly driven by mostly tech stocks. So during a sell-off, we would expect the tech stock will get hit harder which is what we are seeing now. The Nasdaq had more new low than new high on Thursday and Friday. The last time it had more new lows than new highs was on May 14, 2020. It closed with 57 more new lows than new highs on Friday. The index finally fell back in line with the Nasdaq cumulative AD line. To sum up the state of the market based on the sentiment and the internal we just looked at, we see fear is back in the market and risk is being taken off and market participants are buying protections. The up-down volume ratio is showing sign of panic selling but has not reached capitulation level. And the new high, new low continue to show weakness, and there were more new lows than new highs in the Nasdaq market for the first time since May 14 of this year. We will likely see more new low as this correction continues. The S&P 500 is finally falling back in sync with the falling cumulative AD line. Based on the internal and the sentiment, we should continue to prepare for more downside to come. Now let's analyze the price action of the S&P 500 and see where it might be headed. Starting off with the daily price chart of the S&P 500. We saw the price work itself up to this price zone, then got rejected on Thursday's sell-off and found support near the lower trend line of this price channel. Switching to the 60-minute chart, the price zone the S&P 500 entered on Wednesday is the region between the 100% and the 127% major move of this intraday flag. On Friday, the price came down and filled this gap, then reversed after the European market was closed. Switching back to the daily price chart, the potential resistance are the lower trend line of the price channel, the all-time high at 3,588.11, and the 127 Fibonacci extension at 3,720.37. And the potential supports are the gap near 3,318.14 and 3,284.53. Then the psychological round number and these pivot low near 3,200. For now, the longer-term potential support is this Fibonacci retracement zone between 3,054 and 2,725, and this is a Fibonacci retracement set up using the recent recovery swing. Now let's look at the other major market indexes. For the Nasdaq, the index printed a hangman doji on Wednesday, above and outside its price channel. Then it pulled back and found support near the gap fill that we mentioned last week as a potential support. Then on Friday, it proceeded down and broke below another potential support, which is the trend line, and came down and filled this small gap beneath 11,227. Now it has bounced back inside the price channel. So for the near-term resistance, the upper channel trend line and the all-time high at 12,424.79. The near-term potential supports are the lower channel trend line, the pivot near 10,131.94 that is also in confluence with the 618 retracement from the recovery swing. The Dow Jones Industrial, it filled the February breakdown gap, then it sold off and filled the Wednesday gap and the gap near 27,959.50. It found support near the trend line. So for the near-term potential resistance, the all-time high at 29,568.60. For the near-term potential support, the trend line, the gap fill near 27,433.50, the gap down near 24,781.84, which is also in confluence with the Fibonacci 61.8 retracement around 25,000. The Dow Jones Transportation, it moved above the old 52-week intraday high, then came back down, shy of filling the gap near 10,960. For potential resistance and support, we will continue to use those we have identified from last week. The near-term potential resistance is the all-time high at 11,623.60. And the potential support is the gap fill at 10,960. the trend line and another gap fill near 10,640.50, then 9695.50. For the Russell 2000, it broke the trend line support and it found some support near the 1,539.70. For the near-term potential resistance, we will continue to use the 1,610.60 and a pivot high at 1,698.90. For the near-term potential support, 1,461.30, 1,355.80, which is in confluence with the Fibonacci 61.8 retracement near the 1360 level. So in summary, the S&P 500 finally corrected some of its recent excess. From the high to the low of the recent sell-off, it represented only approximately 6.6% pullback. The up-down volume ratio did not show a level of capitulation from the recent sell-off, and the new high, new low is on the verge of turning negative. And the sentiment also showed fear is increasing and risk is coming off and protection are being bought. So from this perspective, we should expect the S&P 500 to see further downside. It could be another 2 to 4% pullback from the all-time high, and that would represent the S&P 500 down near the 3284 and the 3200 level. Until we see some improvement from the internal and some consolidation of the low, we should remain very cautious. And just a reminder, cash is a position. Be sure to click the thumbs up and help me promote and share this video on YouTube. Thank you for watching. Have a great Labor Day weekend and stay safe.